Hello, this is Arlan Suderman, Chief Commodities Economist at StoneX, coming to you from the trading floor in Kansas City. We had another big crop report today, and let's go ahead and get started with that. I should probably put up this page so you have a chance to read that as I go forward. Not a lot of changes in this report, not a lot of surprises, but I think there were some things of interest and of significance, and so we'll talk about those. But we do need to start off with what is the backdrop into which this report came. Price is a function of supply and demand as modified by the flow of money. And if we look at that flow of money, it really comes down to next week's Fed meeting. We have not seen a change in the Federal Reserve's benchmark interest rate really since last July, a year ago July, I should say. So the full expectation is that we will see a rate cut next week from the Federal Reserve. The market is pretty well set on it being a 25 basis point cut. They would like it to be more. I think there's a chance that it could be more. I don't think that it should be more, but I think there's a chance because several members of the Fed have indicated that they would favor front loading the cuts a little bit at the beginning of this cycle. But I think some of the latest economic data that's come out over the past week has probably cooled those ideas. We still have some lingering inflation, particularly in the service sector. That's a problem. And I think that kind of probably takes 50 basis points off the table, but we'll see. This is all up to the Fed and what they're thinking, how they're thinking. Most all the data is now in. They will meet on Tuesday and Wednesday of next week, announcing their decision on Wednesday. So as we look at what's happening Treasury yields right now, one of the interesting developments this week has been the disappearance of the inversion that's been in place between the 2-year and the 10-year yields. Been in place for the last couple of years. That was previously seen as a tremendous predictor of recessions. So the inversion has done a very poor job of predicting a recession over the last 2 years. Yes, there have been segments of our economy in recession, like the housing sector at times, the manufacturing sector, but the economy as a whole has not been. And I've talked about this before. Much of that is and continues to be because of fiscal stimulus that's still in the system, and even it's a lot of monetary stimulus that the Fed has not yet withdrawn from the system. But now that inversion is starting to disappear. There are those who say, well, now that the inversion disappears, now's when a recession is imminent. Let's be clear, recessions have happened over the last 50, 60 years on average of every 6.5 years. Now it comes down to whether you count the 2020 brief recession that was man-made or not. But if you don't, then it's been a little while before we've had a recession. The economies go through cycles. But so far, our economy remains rather resilient. Let's talk about that. The consumer price index the headline number is down to 2.5. However, as we look at the core number, the headline number is largely taken down by energy prices. On the core side, though, we continue to see some sticky inflation in the housing sector, transportation services. In this morning's PPI numbers, producer price index numbers, very similar type of a scenario as well. That's where the stickiness continues to be. But GDP growth in the second quarter was 3%. And so far, third quarter data is showing that it's north of 2% as well. Hardly a recession. Daily data for restaurant bookings continues to be solid. When we look at daily job postings, yes, they are trending lower, but they're still at solid levels. When we look at TSA checkpoint numbers, they're at record levels for this time of year. When we look at same-store retail sales, they're trending a little bit higher overall. Very decent numbers and trending higher. Weekly initial jobless claims at the high end of the typical range for this time of year, but still nothing recessionary about them at all. Jerome Powell has said that the labor market is now balanced. We have 1.07 job openings for every person looking for a job right now. And that still does leave us vulnerable if we do see the Fed overdo the rate cut, shall we say, and really give a shot in the arm to our economy, we could quickly increase consumption to the point where we increase those jobs relative to the number of people available to fill those jobs. That's something that the Fed needs to keep into balance. Unemployment rate is ironic that the Fed has said basically that they don't want to see the unemployment rate go any higher than what it was in last month's report, which was for the month of July at 4.3%. As you can see, that's still a historically low number. And so it was a little bit puzzling why the Fed said they don't want to see it go any higher than that. Now, here's kind of a summary of some of the daily and weekly indicators about the U.S. economy. And frankly, overall, they show a resilient economy that is still doing well. And not only doing well, but in some cases, the daily and weekly data of late showing that we're starting to get a little bit of more upward momentum again after maybe slowing down in July somewhat. When we look at our national debt, upper left-hand corner there, you see that it's at about $35.4 trillion. And so that, I remember back in the 1980s when we hit our first trillion, and what a political crisis that was. And if you listen to politicians, now we're at 35.4 trillion. And right now there's the lid on our debt has been suspended until the end of this year. And so a lame duck Congress and a lame duck president are going to be left dealing with this after the election. Now, if you look at just to the right of that, there I've circled that our U.S. federal tax revenues are a little over $5 trillion. You come straight down from that and you see the interest on our debt. The annual interest costs right now, and this is a couple of days old, so they're now at over $940 billion per year. $940 billion per year, that's almost $2.6 billion per day just to service our debt. Now, to the left of that, you see that we spend $924 billion per year on national defense and our various war efforts that we support. Also, Social Security at $1.5 trillion, Medicare and Medicaid at $1.8 trillion. You add up those four categories and they come to a little over $5.1 trillion. A little over $5.1 trillion for those four categories. And remember, our federal tax revenue is a little over $5 trillion. So that means everything else in government, whether it be food stamps, food programs for the poor, our homeland security, whether it be federal contributions to police and fire, as well as the Department of Education and so many other programs, all are on borrowed money, basically, where we have to borrow money. And we're printing money now in order, or we're borrowing, I should say, we're borrowing and to some extent printing, but we're borrowing money right now in order to pay the interest on our debt, since we're not paying it down. And that creates some problems for us. And that is not sustainable. And that starts squeezing the credit markets. I think eventually starts pushing the longer end of the yield curve higher, which we've started to see happen, even though recently we've hit these new longer term lows. Now, let's take a look at what's happening with foreign ownership of U.S. government bonds. It's trending lower. We're certainly seeing that with Japanese buyers. Chinese buyers overall have been trending lower. Many foreign buyers trending lower. So you have to create that demand for an increased supply of government debt certificates, and that means higher yields. Right now, we've been seeing a lot of retail demand for those Treasury certificates, but as yields go lower, that starts to reduce that retail demand as well. Now, I'm about to change where we go and show the connection here. between all of this and the commodities. So I'm going to show you some correlations, and Mike O'Day of our office found this and shared this, and I thought this is too good. I got to show it. We get a lot of requests for what's the correlation of this and that, and I talk about correlations, but always keep in mind that when you're talking about statistics, you have to be careful of how you look at it and study it, because correlations don't necessarily mean causation. And we have here just kind of this theoretical map. Shows the seasonality of ice cream sales. Obviously, ice cream sales are highest in the summertime. When are shark attacks highest? In the summertime, when people are out in the water. And it looks like a strong correlation, but that doesn't mean that there's causation there. So always when you look at statistics, look at it with a more of a discerning eye. But having said that, let's go in and let's talk about correlations. So we have the StoneX Commodity Index, which is the dark blue line here. It's this basket of 27 different commodities versus the U.S. 5-year break-even inflation rate, which is what the market thinks inflation is going to average over the last 5 years. And you can see how strongly they correlate. And in fact, a year ago, I started talking about expectations for reinflation to come back probably in the second and third quarters of 2024, and the funds who are heavily short will start becoming uncomfortable with those heavily short positions. However, the fundamentals of supply and demand really were not friendly, and so it might be a short-lived short covering rally. And lo and behold, that's what we got primarily this spring. Yeah, I don't draw a very good circle, but that's primarily what we got in the spring. And then when we look at what happened after that, we had the May meeting of the Federal Reserve, where they just kind of declared inflation dead in the following meetings as well. And inflation expectations have fallen below support levels now, and we've seen commodity prices do the same thing as the funds have built up big short positions once again. As we look at the correlation between commodities and inflation, there's a lot of things that go into inflation, but it's amazing how closely they follow together. That correlation a little bit weaker here in 2024, so that has pulled our correlation number down to 0.86. It had originally been at 0.88, but that's still a factor. You see the correlation in this original chart of 0.86 as well. Anything above 0.7 is considered statistically strong. Now let's look just specifically at grain and oilseeds versus the CPI. And it is still very strong at 0.88. And so as a result, as inflation expectations went down, I expected grain and oilseeds to come under more pressure here late summer, and that's exactly what has happened. Personally, I'm anticipating that if the Fed gets as aggressive, and that's an if they get as aggressive as what the market is pricing in for rate cuts, right now pricing in about 200 to 225 basis points by next June, then I think we'll see reinflation pressures come back once again, which changes the level at which the market manages supply and demand. But you can see, even with the funds managed money basically being long the cattle market, that's included in this, grain, oilseeds, and livestock, we're still seeing very large, historically large short positions by managed money in the ag sector. And if you break it down by sector, looking at the 1 year performance, grain and oilseeds have done the worst. And it has the appearance that we've been seeing managed money kind of spread other commodity sectors against the grain and oilseeds, as they've had very ample supplies overall. Now let's talk about some geopolitical risks, specifically China. We continue to look at their birth rate falling below the death rate. The PMI, Purchasing Manufacturers Index, is showing the manufacturing sector continuing to struggle. M2 money supply really trending lower, the money that's available for the consumer. Consumer confidence, and this data was just updated here in the past week, continuing to be very low. In fact, we're hearing that the mood on the streets in China right now is somewhat gloomy. And they have their national fall holiday coming up, and it's normally called the golden holiday, but it's not. They say it's not so golden this year with the mood that you see among consumers. Foreign direct investment into their economy is down almost 30% year on year in the month of July, the latest data that was available. And if we look at China's CPI, we are seeing some very small increases in CPI. But overall, the PPI, which is the manufacturing, the wholesale part of it, still continuing to struggle tremendously there as the U.S. and Canada and Europe continue to deleverage from China. If you look at, these are 5 facts about the demographic challenges in China that I got from Apollo's chief economist. Population growth in China has turned negative. Fertility rate in China is 1, actually slightly below 1. In U.S., it's 1.6. In Japan, it's 1.2. In China, the working age population is currently 1 billion people, and it will decline by roughly 100 billion people every decade as their population ages. There are 30 million more men than women in China. The number of 60-year-old plus individuals divided by the number of 15 to 59-year-old individuals will reach 50% within a decade, up from 30% today, meaning in a decade you'll have very few young people there to support older people. So why am I telling you this? That has a huge impact on policy decisions in China. You can't sustain an economy based on these demographics. And China has stated they want to be the #1 economy and the #1 military in the world. And they believe those two are closely intertwined. And so therefore that drives policy. You have to find ways to expand your economy beyond your current borders in order to do that. And that's what they're doing with the Belt and Road Initiative, what they're doing with their takeover of Hong Kong and their threats against Taiwan. So they're trying to aggressively do that through those means right now. Let's talk about weather. Well, before I go on and say that, let me also say one other thing here about, and I don't have the slides here, because I was running out of time in my preparation to stick it in following the crop report today. Let me talk a little bit about China's officials. The word we're getting is they were closely watching the debate that happened, and they really saw, while the two candidates in their rhetoric anyway would use different methods of deleveraging from China and using tariffs, et cetera, they both have a hard line approach to trade with China. And that's because that polls well with voters right now. And so China is noticing that. Also, that can impact then its decisions about the timing of Taiwan and when it makes its move on Taiwan, which it has promised to do. Also want to mention the other risk. That would be bearish to the commodities, that is the expectations. Something that could be bullish that I've talked about before is in the Black Sea. I've said many times before in the Black Sea that the market has become desensitized to war news there. And that's because it generally assumes that commodity flow will continue through the Black Sea, be it from Ukraine or Russia. But today we have the report that a Russian missile has struck a cargo of wheat just after it left Ukrainian waters headed toward Egypt. Well, the ship didn't sink, but it was struck nonetheless. Is this the beginning of something, or is this a one-off mistake type of a thing? When it comes to the point that shippers are afraid to go into the Black Sea, and or it becomes too expensive due to insurance costs to do so, is when the market will care. Now, today it initially priced that into the wheat market, but beyond that, it quickly dismissed it as a one-off type of incident. If we start seeing more incidents, then the market may start taking a notice of that. That would be for both energy and the food-based commodities that travel through that Black Sea, that region being one of the biggest exporting regions of the world for commodities, energy and food-based commodities. And so that is something we'll have to keep our eyes on. Um, as we look also at weather risks going forward, um, before I do that, I also want to mention something politically. I see we've got a question on this, so I'm going to jump ahead and answer this question while kind of in this. We just did have the presidential debate, and I brought that up a little bit ago, and there was a lot of talk about tariffs. And I've read a lot of analysis on tariffs. And I'm speaking here purely as an economist and making my observations. I see a lot of analysis on tariffs about how it's going to destroy U.S. exports. And what is the reason for tariffs? The reason for tariffs is it can be a very effective free trade tool. And we've seen that play out in over history at times when they're applied properly. So it depends on how they're applied. You can't just assume that tariffs are going to hurt trade. They may actually help trade. The United States is the world's largest consumer. We raise tariffs to get the attention of a country that's exporting to us to try to get them to negotiate. They can't just ignore the demand of the United States, of the consumer, that such a large population. So they need our business, so to speak, if applied appropriately. And a lot of people will point, well, what about the trade war in 2019, 18 and 19, when we saw soybean demand drop off so sharply? Yeah, it dropped off so sharply because African swine fever had decimated 2/3 of China's hog herd. China has for many years been buying as much as they can of soybeans from Brazil and Argentina, and whatever they can't get from them, then they buy from us. And as Brazil and Argentina continue to expand production, which they are rapidly, they are buying less. China is buying less and less from us. That trend is going to continue regardless. That trend is in place for a number of reasons. One is currency exchange rates make them more competitive. Also, the other reason is because of the geopolitical tensions between China and the West over what they're doing in trade policies, militarily, and economic policies and China's desire to be the #1 economy. Why should it send its money to support our economy? That type of a thinking. So that's the direction they're going regardless. And so from that standpoint, when they needed our soybeans in 2019, they waived the tariffs so that they could buy them. And they will do so again when they need. They will buy what they need when they need it, but no more, no less. Right now they need them and they are buying them. But they are simply trending significantly lower each year. Tariffs can hurt trade, but it all depends on how they are applied and how they are used to leverage negotiations. So with that, I'll move on to weather risks. I've shown you these graphics before. The left one showing, well, they're composite maps for temperature and rainfall for the month of August in the 6 years out of the last 30 that had the highest corn yields relative to trend. In other words, these are the years in which, and you see the years listed there, all underlying, you see the years listed. Those are the 6 years out of the last 30 that had corn yields that were above 5%, above trend. And so you can see there that we basically had a cool Midwest. Now, I tried to create a map for this year on this website that does this, but it didn't have the August data in there yet in order to create the map. So I did create a map, but it'll look different. I'll show you that in a little bit. And on the right, you see rainfall. So overall, that's basically mostly a half inch to an inch, in a few cases, 1.5 inches above average for rainfall. And I'll kind of show you some stuff on this year as well here as we go forward. And they said these years are when we had the big crops. Those are the ones that had the big yields. Now, this year hasn't been quite as good. Let's take a look at this year. This is August. This is a ranking. This website I wish I could have made it just like the other one, but that website didn't have all of the August data in yet, so I couldn't do that. This is a climate district ranking out of the last 132 years. So you see Northwest Missouri there. It was the 100th coolest August on record out of 132 years. And so that speaks volumes about how mild it was. Same thing with East Central South Dakota. Overall, it was a very mild August. You look at rainfall, it is a little bit more varied, a little bit more extremes. You look at portions of Iowa, it was pretty dry. Obviously, we see in the South, it was pretty dry, some of the driest August on record overall. But some good moisture elsewhere. You look at Minnesota and parts of the Dakotas, even parts of Illinois, central Illinois, some good rainfall, though some of it was more later, maybe mid-month to later. And so how does that come out? How does that affect yields? Well, USDA kind of told us what their opinion was today. And we'll continue to see this play out as we go forward, but I think that's why we have record corn and soybean crops overall. Now, as we look at what's been driving the weather, we finally have a La Nina here in the Central Pacific. A La Nina is defined by water temperatures 1/2 degrees Celsius below normal or more, or cooler. And we're finally now at 0.65 roughly degrees Celsius below. Another factor that's been driving it is this heat that we have here in the Northern Pacific, the heat we have in the Northern Atlantic, and this low that we have up here between Siberia and Alaska. Those factors have been driving our weather pattern, and now La Nina is starting to have more of an influence. So as we apply that then to the European model forecasting long-term, and confidence in these long-term models is not high, but it does give us an idea of the direction we're going. These are very La Nina maps, precipitation maps here, not temperature. Basically dry across the south. Now, as long as hurricane season is in place in October and early November, you can still get a lot of wetness down here in the south and in the mid-Atlantic as well. But these models don't pick that up. They can't forecast that, so they don't show that. But it really shows wetness up here in the Pacific Northwest. Try that again. Stretching out over into the northern plains and drier elsewhere. And then as we get into the winter, we tend to have a northern polar jet stream that kind of dips down like this and then shoots up like this. And so we get this wintry weather in the Ohio River Valley. We get a wet Pacific Northwest, and we leave the southern plains. See if I can do a D there. There we go. We leave the southern plains on the drier side. That's a very typical La Nina if we continue to see this La Nina develop. How about South America? Well, right now it is been dry in Argentina, but the rains are starting to fall. It's dry in central and northern Brazil crop areas, but that is starting to change. The rains have really been coming in here with some flooding even reported here in southern Brazil. I don't make a very good X there, but we've even had some flooding there. It's been very dry up here in Mato Grosso do Sul, down in Paraná. Over the next 10 days, we expect these rains to really start filling into the southern half of Mato Grosso do Sul, but still stay dry primarily in crop growing areas of Mato Grosso. We may see some rains come in here to the west of that line in Mato Grosso. Now let me clear that out. If you look at the 30-day outlook, basically from September 20 to October 20, we see that once we get into the first week of October, we start seeing rains return to that area. And in fact, the longer term models for December, January, February show quite a bit of rain in that area. So in drier weather down here to the south of that, in Argentina and in southern Brazil. And Argentina is not totally dry. It just comes down to distribution of the rains and the timeliness of the rains. We can't assume that Argentina has a dry crop, or a short crop, but the odds are a little bit higher it will. Southern Brazil, the same thing. But typically in this type of a pattern, Brazil ends up having big crops because the good yields or above trend yields in the north more than offset the low yields in the south. So right now, our people in Brazil are assuming normal crops. That's 165 million metric tons of soybeans, up from 149 million metric tons this past year. And they have one of the lower production estimates at 165 that I've seen. They go all the way up to 170 in other estimates. So the risks of a big crop are certainly there. Let's look at those supply and demand fundamentals. This morning's report put corn crop at 183.6, soybeans unchanged at 53.2. USDA in August was at 183.1, so that's a half bushel increase in the corn yield. Our last customer survey was at 182.9. So USDA 0.7 of a bushel above us. That's within the margin of error. You know, which one of us is right, we'll find out. The trade was expecting 182.4. That's 1.2 bushels per acre below where USDA came in. That is significant. The trade was not expecting a change in soybeans, and that's the way it ended up. And so we ended up with roughly the same size soybean crop the trade expected, but yet a bigger corn crop by about 110 million bushels, bigger than trade expected. So that's more bushels. What did USDA do with that? I'll break down the balance sheet in a little while, but basically they increased old crop ethanol demand and old crop exports, and that lowered the ending stocks for old crop by a total of about 55 million bushels. Then that became a lower beginning stocks number for the current year. And then when you factor in the demand for this year, ending stocks did end up higher than what the trade expected by about 50 million bushels. As you'll see here, about 50 million bushels higher than the trade expected, but down 16 million from last month and down just 4 million from what we had anticipated. No, they did drop soybean ending stocks primarily because of adjustments again to the old crop balance sheet. The increase crushed by 5 million bushels, and they cut some residual use and other factors minus, so very modest changes there. There is nothing bullish about 550 million bushels. In fact, I'll talk about that here in a little bit. If we look at world ending stocks, nothing earth-shaking here. On the world balance sheet, we did see them come down 4 million metric tons on the size of Europe's wheat crop to 124, but there are some estimates out there at 116. So there may be more downside coming from Europe. And the other thing is Russia. Do we see more downward adjustments for Russia? Some of the private estimates are now starting to do that because of adverse weather for the spring wheat crop as it was developing. So the question is, with food inflation starting in Russia, and Ukraine starting to take the war now to the people of Russia with strikes deep inside of Russia, even to the Moscow area, at what point will Putin start cutting off exports of wheat, restricting them, limiting them? That's something the market would pay attention to. Or as I said, the risk to freight, to shippers, does that do it? That's something we'll have to keep our eyes on the wheat front. Other than that, none any big number changes on the world number. You see the higher wheat number, and that really goes back 2 or 3 years. USDA made some back upward revisions to Canadian wheat stocks, several million metric tons. That was the big thing there, increasing global wheat stocks. Here's our numbers from our latest customer survey. On the left and on the right, you see my yield models. My yield models are based on crop ratings. They are not our official StoneX numbers. Those come from our customer survey, which you see on the left. But I put my yield model track there so you could just kind of see how, and these are all seasonally adjusted, how they've changed as we've gone through June, July, and August, kind of the fluctuations of those yield estimates overall. If we look at today's crop report and the corn yields estimated today versus the August report. Now, this report was the first one where they actually took into account field samples, weighing samples, trying to get a feel for seed size. So I was very interested to see what they'd find. Illinois at 222 bushels per acre really matches our survey estimate. And that just blows away the record there. In fact, I put a red line under in every state that had a record yield estimated by USDA. That's 10 state records there in there today, all the way from Nebraska and South Dakota to New York, showing record corn yields. When I show you soybeans in a little bit, it's 6 record yields. But you can kind of see what today's yields are, how much they're up from the previous month in bushels per acre, and whether they're a record or not. Let's look at the balance sheet. And again, as I've said before, this is the old crop corn balance sheet from USDA. Right beside it is the new crop marketing year that just started on September 1st. And I highlight in red here that USDA added 15 million bushels to its old crop ethanol estimate. I had added 5. So maybe they know something more than I do about what happened in August that didn't show up in my calculations. They added 40 million bushels to exports. I was about 10 million bushels higher. And it really comes down to how much non-inspected corn there was. And we can estimate that, but non-inspected shows up in the census data, and that is not made public for typically 4 to 6 weeks. So we don't have that yet for the month of August. And so USDA would likely have more data available on that. So I really can't argue with that number too much at this point until we see that data. But USDA puts new crop ending stocks at 2.057. I'm at 2.061. So I'm very close there to where USDA is at. If you look at fund positions, managed money, still very large short positions. Export sales, and we're switching to soybeans here. Soybeans. And when you look at it on a seasonality basis, now that we're in the first week of September, first week of September, marketing year soybean export sales to all destinations fall short of the seasonal pace they need to be on to hit USDA's target by better than 150 million bushels. That's a significant amount, and that's largely due to sluggish Chinese purchases. They've picked up of late, but that's still way below where they need to be at this point. And you can see that market share continues to trend lower for U.S. exports, largely because of the trending higher of South American taking world share for soybeans. If we look here, and I like this graphic, it comes from our market portal, the big increase in Brazilian soybean production and area planted to soybeans in Brazil. That's for the big, pretty flat in Argentina, although is expected to go up this coming year as they plant less corn. United States, not, pretty much within a range of movement from year to year as well, but Brazil continuing to expand. Chinese soybean demand, there's some real debate on these numbers, but I see it overall kind of flattening out. Let's talk a little bit about biofuels, particularly the liquid biofuels, and that's really been impacted by a surge in imports of used cooking oil. Now, USDA Secretary of Agriculture, Tom Vilsack, said recently that he does not want to see us put restrictions on used cooking oil coming from overseas. It did sound like he was in favor of tightening up inspections to make sure that's actually used cooking oil, but he doesn't want to limit what comes from overseas in the way of other quantities. He's fighting back against some congressmen and women who are trying to get limits on the subsidies going only for locally produced, domestically produced feedstocks for the green diesels. That would be renewable diesel, biodiesel, etc. Another factor that plays into this is the California Air Resources Board, which sets policy in California and which gets followed by other states as well, is now moving to cap oilseed use for feedstock for green diesel production at 20%. So no more than 20% of the feedstocks that go into producing these green diesels can come from oilseeds. That is a huge blow to the oilseed industry. And what it's expected to do when you combine that with China opening up the anti-dumping investigation on rapeseed coming from Canada is expected to funnel a lot of canola oil down into the United States to our liquid biofuels plants. So again, that's another bearish factor for the oilseed market. And so you can see what's been happening to RIN prices for the D4 RINs, really been hurting us with these developments, and that's a big part of the margin, the profit margin that we get for crushing in order to produce these biofuels. And we're seeing that that we're seeing stocks of soybean oil start to work their way higher. I've already mentioned much of this already. Okay, we'll move on. Soybeans, 6 states have record soybean yields if USDA's data verifies going forward. When we look at the soybean balance sheet, not a lot of changes. They did end up dropping ending stocks by 5 million bushels because of a 5 million bushel increase in crush. That lowered beginning stocks for the new marketing year by a like amount. Other domestic feed and residual seed usage also increased modestly, resulting in a decrease of 10 million bushels to ending stocks from 560 last month to 550, but there's nothing bullish about that at all. My number is much larger at 627. I have a little bit lower yield, but when you look at my crush number, it is lower now than USDA. Excuse me, higher by 15 million bushels, but my export number is 115 million bushels lower than USDA. And as I said, export sales now trail the seasonal pace needed to hit USDA's target by over 150 million bushels. Same thing happened a year ago, and USDA had to bring its target down. And unfortunately, I'm anticipating the same thing happen this year as well, unless South America has a major failure in its crop. The funds near record short in soybean ownership there as well. If we look at wheat numbers, really no change to the wheat numbers from USDA this time around to the domestic numbers other than the world numbers that I mentioned to you. Hard red winter wheat really has the big stocks that are really weighing on the market at this point. If you look at world wheat stocks, over half of them are in China. And so that continues to be a problem. But look at the traditional exporters, relatively low. And then you throw in the role that Russia plays as an exporter. And its stocks really tightening up now. And I've got a graphic to show this. You see that as a percent of annual usage, major wheat exporter use is getting near historically low levels right now. The wheat market has not really acknowledged it. I think it will play more of a role, and it hasn't acknowledged it yet because Russia is still sending out wheat at sub $220 a ton levels. In other words, its cash prices have not started working their way higher like the board has. Something's got to give at some point. And I think it may be at least in the last half of the marketing year, maybe sooner, but the last half of the marketing year, as we see our exports really exceed expectations. With a short crop in the Black Sea, a short crop in Europe, and some dryness in the southern plains being kind of the primary driving factors. This is looking at 30-day rainfall for Russia's winter wheat area, and you can see it's just been bone dry over much of the winter wheat belt. And when you look at fund positions, this is a place where the funds have lifted a lot of their fund positions, particularly in the Chicago market. If we look at Kansas City, still near record short positions. So what is the take-home message today? And then we'll have time for questions, maybe something I missed or something you want to ask a question about. You can go to the question and answer session there. I see that we already have several questions there that we'll address in a little bit. But the take-home points, this year's U.S. corn, soybean, and wheat crops are big, and big crops are still getting bigger, especially for corn. The weather patterns, and I should add that USDA didn't make any changes to its wheat production estimate, and it rarely does in September because it's waiting for its September 30th small grain summary report when it'll do those changes. Weather pattern supports a rapid dry down of this year's fall crops, which is expected to lead to a fast harvest and bringing those bushels to town rather quickly. Storage will be a problem if that happens, likely pushing bushels onto the market, putting downward pressure on both basis and on the board. Now, Brazil is dry, but as I indicated, the monsoon rains are expected to return in time for the crops. As early as farmers would have liked, no. But in time for the crops, I think that we can maintain good production expectations at this point. It's currently dry there, but the monsoon rains are expected to return on time. Now, Argentina is shifting away from soybeans. 20 to 25% is kind of what we're expecting reduction in corn area going forward this year. Argentina is shifting towards soybeans in most of those acres and away from corn. U.S. corn and wheat exports should improve in the last half of this marketing year, allowing things to stabilize, particularly after we get past the gut slot of harvest for the world wheat crop, as I mentioned before. U.S. corn and wheat, I read that. Commodity deflation remains the theme near term overall. Keep your eyes on one other thing I haven't addressed yet, and that's the risk of a longshoreman strike on the Gulf Coast this year. October 1st is when longshoremen lose their contract. Their contract expires, and it's rather heated and emotional at this point. But that is something that could end up coming back and creating some problems in exports. I will also say that low water levels on the Mississippi are a concern as well. Now, Hurricane Francine has moved right up the Mississippi River Valley and has temporarily helped somewhat. That's not a long-term fix. We need more rains in the Midwest. And so it's something we're going to monitor going forward. But with the Panama Canal reopening, that puts more harvest pressure, export sales opportunities on the New Orleans port facilities than what we had a year ago when the Panama Canal was closed. So watch closely to see whether we get a strike that could shut down our exports going forward. And with that, I will say thank you, and we'll take a look at the questions that we have come and start answering some of those questions.
Thanks, Arlan. The first question we have here is, what would be the potential impact from the China anti-dumping investigation on Canada canola imports?
Yeah, the expectation at this point, and China actually tried to give Canada an out again and said, well, we're going to take a year to do the investigation. If necessary, we'll extend it another 6 months, just showing the political nature of this whole thing. And Canada responded by saying, we think we're going to add some more products to the tariff list. And so it's generally thought, and what our people in China are saying, it's generally thought that buyers will be reluctant to buy rapeseed from Canada. So it's going to back things up in Canada, and we're anticipating we're going to see a flood of canola oil coming south out of Canada to biofuel producers here in the United States.
The next one we have is back to the presidential election. Could you remind us the directional impact to grain and oil seeds if either candidate is elected? Are there other top-of-mind impacts besides renewable fuel demand for soy oil and exports of grain and oil seeds?
Yeah, we don't know a lot about Harris's positions. She hasn't posted much. We can kind of go a little bit about things that she has said. But basically, we don't expect a big change under either administration to the biofuel program, but that isn't necessarily good. Our big problems are right now is the aggressiveness in California policy trying to push us toward electric vehicles. And at this point, we've heard nothing from Harris to indicate that she would counter that. And we're certainly not seeing it from this current Biden-Harris administration. I don't know that we'll get any more support from Trump, but I do, based on what he said, will see less support for electric vehicles, and therefore you wouldn't expect the big pressure to push people away from even the liquid biofuels as California is.
Shane is saying mini wheat seems to keep showing decent strength even after the USDA today. What do you think is the main drivers of spring wheat off the lows?
We got cheap enough, basically. It doesn't mean we can't make new lows, but I think the market is starting to look at the problems and the quality issues, especially in Europe and in the Black Sea, and starting to get bids now and price in more demand for the quality milling wheat that we produce, which starts with spring wheat here in the United States.
Is corn losing any acreage to cotton as a cover crop in Brazil? Is cotton a better cover crop?
Good question. The concern is if we have a delayed soybean planting in Brazil that can delay planting the corn crop and may lead to more cotton acreage. And if we continue to see a return to low prices in corn, that may also encourage it there as well. China has been moving more and more of their cotton business to Brazil, as far as where they're sourcing their needs, just like soybeans. And so there has been a little bit more interest in cotton. But a big question to answer is when will those rains return? And that'll have a big impact overall on what we see at that acreage mix. But we do expect some shift, yes.
The last question we have is from Shane. He's asking, did U.S. import French wheat? Will this continue? Is this negative prices?
They have, yes. That's not all that rare, but they have. This week, it made the news of a cargo that came from France into New York to a mill there. And what we've learned is that was something that was a deal that was made long ago when we were in the old crop year. And so they kept it on. Probably shouldn't have. The seller probably shouldn't have. They probably could have done better if they would have canceled that overall. But it was kept on and maintained. And so it did negatively affect our ability to produce domestic demand here, yes.
Those were all the questions we got.
Okay, thank you very much. If you have more questions, you can reach out to me with a direct message on X, formerly Twitter. I do see there's another question come in, and I'm gonna address it. I've addressed it to some extent, but the high used cooking oil inventories or imports, should probably better say, should the U.S. apply tariffs to residuals? I really think that this administration has made it clear, based on Vilsack's comments, that they are not going to do anything to restrict it. The EPA is investigating whether it's actually used cooking oil, because we're really getting more used cooking oil than what there would be expected to be cooking oil, period, coming from that area of the world. I'm not a chemist to be able to say how easy that is to detect differences or whatever, whether they're taking virgin palm oil and just treating it with a little bit of used cooking oil, making it test positive. I can't answer that question. So would they restrict it if they determined that was happening? I don't know with this administration. But this administration has basically indicated it will not apply tariffs. I do think that what Trump administration said that they might, but their overall commitment to liquid biofuels hasn't been overly impressive either. Not that they've been against them, not just they've been more neutral towards them. And I also see the comment there about my diet root beer that I'm drinking as well. But thank you very much, everybody. I really appreciate it. You can direct message me on X if you have any more questions that come up. Otherwise, I look forward to being back with you a month from now in October, when we'll know a lot more about weather patterns in Brazil and about the size of the U.S. crops. I think that report will tell us a lot. I look forward to seeing you then. Thank you very much.